Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, July 18th, 2026. Hey, how you doing? I hope you had a good trading week. I hope you're having a good weekend, and I really appreciate you coming to my weekend review. I hope you're going to find it educational and helpful. The format for today's podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, the ones that I'm currently in, the ones that I exited, any new trades. We're going to talk about when I took the trade, why I took the trade, what the setup was, what the confluences were, what the strategy was. Then I'm going to show you how I position size based upon the volatility of the market, how I place my emergency stop, how I place my end of bar stop, how I take partial profits each day if the market moves a certain distance from the previous day's close, what it means to go into trailing stop mode, and then ultimately how I exit the trade if it gets to overbought levels. So we'll talk about when I entered the trade, why I entered the trade, and how I am managing the trade going forward. I had a pretty good week, really, all in all, considering that the market was, well, the Qs and the SPYs were down pretty significantly, but I was in some good positions that were green. Not all of them, but like I said, I'm going to share those with you. So anyway, quite happy with how the week went, especially considering how the overall market went. So after we take a look at my trades and my positions, I'm going to spend a few minutes and talk about trader psychology. It's always the most important skill in trading. I've been trading for over 30 years, and the ability to create a plan and stick with it is key to your long-term success. It really is. It's the greatest skill in trading, the ability to follow your plan. So it's always helpful for me to teach trading psychology, and I hope it's helpful for you. I hope one day you'll hear something that I say that will resonate with you and will improve your trading. After that, last night I went down through my master watch list, and I have identified some potential new trades for next week. Now, these are not where they need to get to yet, but they are within striking distance of some key levels. And when I say key levels, I'm generally talking about order blocks, major moving averages, 30 RSI levels, double bottom bullish MACD divergences, and ideally all of these happening at the same time. So I have some pretty good ones that I'm going to share with you. I hope that's going to give you an idea of how I look at trade and how I kind of put my trades up on the weekend. I follow them the following week. And if they get to where I thought I wanted to enter the trades at, I will definitely consider entering those. So I'll share those with you. So anyway, if you find anything helpful in today's podcast, I really would appreciate it if you could just take a quick moment and hit the thumbs up button. It really does help to build the channel, keep the channel around, lets YouTube know that there's some valuable content here. All right, so let's run this U.S. legal disclaimer, get that out of the way, and then we'll get rolling. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, well, thanks for holding through that with me, and let's get started on my current open position. So the first on deck is Walmart. I did buy Walmart back here on the 2nd of July at 111.81. This was a very high probability trade setup, and you can see it has worked quite well since I entered it. But in general, I like to find confluences of signals. So this was a confluence in broad terms of a rejection of the bottom of the order block and a rejection of two deep dip buy signals, rejection of the 30 RSI and a rejection of the 300-day moving average, which is the orange line here. So let's first talk about the order blocks. I would say 90% of all of my trades involve an order block, and this is this green box right here. If you're not familiar with order blocks or you don't use them, I would highly recommend looking into them and using them. Of course, they don't work all the time, but they certainly, in my experience, work a lot more than they don't. So this order block was formed in the past, this green box, or in other words, I like to call these the order blocks smart money areas. And so let's go back into the past when it was formed, and I'll explain the details. So this order block was formed all the way back on the 8th of January. Now, we need a few things to happen in order to create an order block. And the first thing we need to look for is we need to look for a swing low. And here's the swing low here on the 2nd of January. A swing low is simply a low that has a higher low to the left and a higher low to the right. So that's it. Higher low to the left, higher low to the right. After the swing low, I need to find a swing high. Now, a swing high is just the opposite of a swing low. A swing high is a high that has a lower lower high to the left and a lower high to the right. So now we have two of what we need. We have a swing low followed by a swing high. Now, the next thing I need to find is another swing low that is lower than the first swing low. So this was the first swing low, swing high. Well, here we go. This is a swing low because it has a higher low to the left and a higher low to the right, and this swing low is lower than this first swing low. So when we have these three things, now things are starting to get interesting, and I want to be able to key off of the swing high that we originally talked about. So swing low, swing high, lower swing low. Now in the future, if the price goes above the swing high is right here, like it did here, swing low, swing high, lower swing low. This is the key bar because it took out the swing high. As soon as this happens, now I can define the order block. Order block is just the lowest closing bar prior to market structure change. And when you take out the swing high, that is a market structure change. And as soon as that happens, the high and the low, the lowest closing bar before the market structure change is the order block. So I just take the high and the low of this bar and move it into the future. So I want to be interested in buying Walmart if it comes back into this green box. So this was the order block here on the 8th. We changed market structure to the upside, and was it correct? Yeah, it sure was. But the point I always like to try to make with order blocks is look here in the future, a few months later, way up here. We know that the order block was formed. This is the order block area, and we went from here all the way to here. So in hindsight, is it fair to say that smart money was buying in this area? And I would say 100%. I mean, it's pretty obvious that when you're all the way up here and you look back to this order block, that this was smart money. So the idea is this was smart money. I don't think we can debate that. But the question is, will it be smart money if the price comes back down to the area that was once smart money? And the answer is definitely not for sure, right? I mean, yes, this was smart money in this case, but it doesn't mean that in the future, if Walmart comes back down, it's going to be smart money again. But again, in my 30 years of experience, it is smart money again more times than it is not. Now, of course, we need stops and levels and everything to key off of, but that's the general idea of an order block. Swing low, swing high, lower swing low, market structure change. As soon as that market structure change happens by taking out the first swing high, I can define my order block, the high and the low of the lowest closing bar before market structure change, and I bring it into the future. And now I just wait, right? I just wait for the price to come back down to that smart money area. Well, it took many, many months to get there, but back to when I took the trade here on the 2nd, right? So There are multiple ways to enter a trade from an order block. You can have an order block with the rejection of the high of the order block. You can have a rejection, you can enter with the rejection of the low of the order block. You can have key levels within the order block. There's many different ways, but this particular trade that I took here on the 2nd of July at 111.81 was a confluence of multiple things. The first is, look at the day before. We closed below the order block. Okay, we closed below the smart money order block. Now, in the future, if it closes back in the order block, that's a rejection at the bottom of the order block, and that can be used as an entry. But this trade was a lot more than that. It was a lot more than just a close under, close back in the order block. Let me bring your attention to the 300-day moving average, this orange line. It's a major moving average, a major deep dip buy strategy indicator that I use. Well, I told you at the beginning of the podcast that I like to use confluences. And so the confluence of this trade was a close under, close over the bottom of the order block, and also a close under, close over the 300-day moving average. Two different strategies, but they happened at the same time. In addition to that, the previous day we closed under the 30 RSI. On the day that I took my entry, we closed over the 30 RSI. Any of these three, the 300, the 30 RSI, or the rejection at the bottom of the order block by themselves is a legitimate entry, but these all happened at the same time. In addition to that, you can see this gray line here, this kind of thick gray line. This is the negative third ATR channel. Previous day before I entered it closed below. The day I entered, it had closed above. Now, the order blocks, the major moving averages, the RSI, these are primary signals where I can take a trade just based upon those. A rejection of the negative third ATR channel is not a primary signal, it's a secondary signal, but having it is kind of cherry on top. It improves the quality score of the trade. Okay, so rejection at the bottom of the order block, close under, close over the 300-day moving average, close under, close over the 30 RSI, and a rejection of the negative third ATR channel. So I entered here 111.81. So, okay, first thing I need to know when I am going to enter a trade, probably the most important thing in trading is how many shares am I going to buy, right? I have a really simple formula that I use. I take 1% of my total trading account and I divide it by the value of the 2 ATR. The 2 ATR value will tell you what the volatility of the market is. So let's just say I have $100,000. 1% of that, $1,000. This is the maximum I am going to risk on this trade. If I had $200,000, 1% would be, if I had $200,000, 1% would be $2,000. $50,000, 1% would be $500. So I take 1% of my total trading account. If I have a $100,000 trading account, 1% of that is 1,000. And I simply divide it by the value of the 2 ATR. Right now, the value of the 2 ATR is 555. So divided by 555, that would tell me to buy 180 shares. It's perfect. My maximum loss is $1,000 on this trade, and I've position size based also upon the volatility. So here I have my signal. Enter here 111.81. I buy 180 shares. The first thing I do is I take my entry price minus the value of the 2 ATRs, and I put this red line down here. This is my emergency stop. This is exactly 2 ATRs below my entry. So if I have 180 shares and it goes down $5.55, how much will I have lost? $1,000, right? That's the max I want to lose on this trade, 1%. But the good news is this emergency stop only hits about 5% of the time. The other 95% of the time, if I have a losing trade, it will not be because I hit my emergency stop. It will be because I closed below my end of bar stop. So an end of bar stop, depending on the strategy that you use, can change. But for me on this trade, the close under, close over the 300-day moving average. When I took that trade, my end to bar stop was a close below the orange line, a close below the 300-day moving average. And 95% of the time, if I have a loss, it's going to be my end to bar stop, not my emergency stop. And the end to bar stop is always going to be closer to my entry. So the closer I can get my entry to my end to bar stop, the greater the risk to reward ratio that I have. All right. So I enter here 180 shares. I place my emergency stop 2 ATRs below. My end to bar stop is a close below the 300-day moving average. Close, not during the day, a close. I always base my my entries, my exits on the closing price. I think it's the most valid price of the day, except for the emergency stop. If I hit the emergency stop, no matter what time of the day, if I hit that, I need to get out because now I have lost 1% of my account. I can't wait around until the end of the day to potentially lose more, right? But for my end of bar stops, I wait for the close of the day. Okay, so as soon as I have placed my emergency stop, as soon as I know where my end of bar stop is, the next thing I do is I take my entry price and I add the value of the 1.5 ATR to it. And I place that above my entry. This is this orange line. So in the future, if I make it up to this orange line, now I'm in trailing stop mode, which just means after reaching trailing stop mode in the future, if I have a close below a previous bar's low, I'm going to exit half. So, in trading, when you take a trade and it starts moving your way, you want to start tightening up your stops if it starts moving nicely in your direction. So I don't tighten up the stops per se. I leave all the stops where I initially had them. It's just that when I am in trailing stop mode and I get to trailing stop mode and then I have a close below previous bar's low, I sell half of the shares. This has the same effect of moving all my stops up, okay? And so that's the orange line here, my 1.5 ATR trailing stop level. I place that 1.5 ATRs above my entry. So everything I have talked about so far, as far as the emergency stop, the end of bar stop, going into trailing stop mode and exiting half if I have a close below previous bar's low, these are all defensive moves. In other words, if the market goes against me, I need to take some action defensively. But I don't just want to play defense. I also want to play offense. And so there's a way that I play offense in my trading as well. And that is I take a partial profit or partial profits each day if the market moves a certain amount from my end of bar close. So I am currently in Walmart at the moment. So let me show you exactly how I will do this for Monday. It's very simple. I just take the closing price each day. Right now the closing price is 114.24. And now I look for the value of the 1.5 ATRs. The value of the 1.5 ATR is $1.25, and I simply add those together. Closing price 114.24 plus $1.25. My first profit target for Monday is 115.49. So let me just mark this up here, 115.49. That will be my first profit target for the day. I always place 3 profit targets each day. So the first profit target's 115.49. To get the second profit target, I just take the first profit target, 115.49, and again add the value of the 1.5 ATR. My second profit target for Monday is 116.74. And I'm going to do it one more time. I have 2 profit targets now. One at 115.49, one at 116.74. To get my third profit target, I simply take my second profit target, 116.74 plus 1.25. My third profit target is 117.99. And so the question is, how much do I take off at these profit targets? Remember, I place 3 every day. It's very simple. I take 10% off of however many shares I go into the day with at each level. So if I go into Monday with 100 shares, I'm going to place 3 profit targets. 10 shares, just 10%, 115.49. 10 shares at 116.74, and 10 shares at 117.99. If I have 50 shares, I place 5, 5, and 5. If I have 1,000 shares, I place 100, 100, 100. Okay, it's easy. And so, if it moves up decently, maybe I hit one profit target and that's it. But at least I take some, I lock in some profits. The market can't take those profits away from me. Each time I hit a profit target, I have a less of a position. It's less stressful. If it's less stressful, I'm more likely to follow my process. And another big advantage is that if I hit nice profit targets and then the market just collapses on me, well, it mitigates my loss because I have fewer shares. So I take and these partial profits, they really add up over time, right? The market can't take them away from you, reduces your position size, and mitigates your loss if the market then moves against you. So I'm a big fan of taking partial profits, and it just makes sense to me. Like with sports, you need to play offense and defense. If all I do is play off or defense, it just doesn't feel comfortable. I need to play offense and defense. So the emergency stop, the end of bar stop, going into trailing stop mode and selling half if I have a close below previous bar's low, defense. Taking the partial profits each day, offense. Okay, so I've kind of covered the bases of kind of how I set things up, and so let's just run through the trade now and just see how it did. Again, entered at 111.81 on the 2nd of July. Why? Multiple signals. Close under, close back in the order block. That's 1. Close under, close over the 300-day moving average. That's 2. Close under, close over the 30 RSI. That's 3. And then cherry on top, secondary signal. Close under, close over the negative third ATR channel. I entered at 111. I position sized correctly and entered at 111.81. Placed my emergency stop 2 ATRs below. If I got there, I've already done the math. I'm going to lose 1% of my account. My end of bar stop is a close below the 300-day moving average. And I placed my trailing stop level 1.5 ATRs above. So here we go. Next day, up, down. During the day, it was below my end of bar stop, but it closed back above it, keeping me in the trade. The next day, we gapped up. I did hit a profit target into that strength before it reversed. The next day, gapped up again, hit a profit target into that strength. Next day down, next day up, profit target. Next day up, profit target. Next day, we got to trailing stop level. Now I'm in trailing stop mode. It doesn't mean I do anything. It just means now in the future, if I have a close below a previous bar's low, I'm going to exit half. And that's exactly what happened here. Or that's exactly what it happened on the same day. See, we got to the trailing stop level and then we closed under the previous bar's low. So I took half of the remaining shares. Remember, I say remaining because I did start with a greater amount and then I've been hitting these profit targets on the way up. So it's just the remaining shares, and I exited half of the position for a gain of 1.66%. But remember, I still have half, and I'm still on the half that I still have, going to use that 300 as my end of bar stop. Next day was down. Thursday was up nicely, hit multiple profit targets into that strength. And then this morning, it was really, really strong, and I hit multiple profit targets before it reversed. So if this in the future starts coming down, 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 you can understand how I would certainly be glad that I hit multiple profit targets up here. All right. So the remaining shares that I have on this particular trade at the moment, up 2.14%, but this was a very high probability trade, confluence of signals. And going forward, if I close under the 300-day moving average, that will be it. If it continues to move up, continue to hit profit targets. And then ultimately, if we get to certain levels, 65 RSI level, 70 RSI level, then I have other rules that come into play that would completely get me out of the trade. But anyway, remaining shares on Walmart up 2.14%. Okay, next position I'm in is CRM, Salesforce. Now, on Walmart, I just explained to you my process of taking partial profits, going into trailing stop mode, end of bar stop, emergency stop. Well, there is one particular strategy that I use where everything I just told you I don't use, but it's only really on one strategy, but this is the one. So I'm going to show you. So let me bring your attention to this blue or this bar that I've highlighted in blue. The reason that I highlighted this in blue is the previous day we gapped down. So from the close to the open, we gapped down, which is bearish sentiment. However, the very next day, it gapped right up. So why is that important? It's when you have a sudden shift in sentiment from gapping down to gapping up, this is called an abandoned baby. That's why I highlighted it in blue. And when you have these sudden shifts in sentiment from bearish to bullish, very often, more often than not, when you look in the future, the price will be higher, just like it is at this point. So these are very strong trades, and I like to diversify the process that I trade just a little bit. So on this particular trade, I position size like I normally do, 1% of my trading account divided by the 2 ATR. And my stop on this trade is the 2 ATR. It's a 1% loss if I am wrong. However, to the upside, I place a 4 ATR profit target, or in other words, a 2% profit target. So I'm risking 1% to make 2%. Now, going forward, I'm pretty sure eventually either my stop is going to hit or my profit target's going to hit. I don't know when, I don't know where, but eventually one of those two will hit. But the whole idea is waiting for a setup that gives me a higher probability to make 2% than it does to lose 1%. And that's exactly what I did. So I entered here on the 25th. I didn't enter it right when the abandoned baby took place, but I looked for a little bit of a pullback, a little bit of a check back here. And the reason that I got in here at 150.10 was because we rejected the negative third ATR channel and we basically bounced right at the 30 RSI. So that was my decision to buy there. 150.10. I placed a 2 ATR stop below me and a 4 ATR profit target above me, and I'm just going to let it go. Eventually, I'm not taking partial profits. I'm not going to trailing stop mode. This is an all or nothing, lose 1% or make 2%. So this one's pretty easy. It's doing quite well. Have not hit my stop or my profit target, but at the moment it is up 11.99%, again, based upon the bullish abandoned baby. Microsoft's pretty similar trade to Walmart. I entered Microsoft here on the 26th of June at 373. Again, very similar to Walmart. Almost exactly the same signals. Close under, close back in the order block. That's rejection at the bottom of the order block. Close under, close over the 30 RSI. Closed under, closed over the negative third ATR channel, and kind of cherry on top for this one is we have a V2. A V2 consists of 3 bars, bar 1, bar 2, bar 3. Bar 2 has to go below bar 1's low, bar 3 has to close above bar 1's close. That is also a secondary signal, not a primary signal, but it improves the quality score of the trade. So I enter the trade here at 373. I place my emergency stop 2 ATRs below. My end of bar stop is a close below the low of the order block, or in other words, close below the bottom of the green box. Place my 1.5 ATR trailing stop level above, and next day kind of gapped up. I hit a profit target before it reversed. You can see it was below the low of the order block, but that's why I wait for the close. It closed back in it. That kept me in the trade. Next day up a little. Next day up nicely. Hit some profit targets into this move up. The next day up again. Profit target. Next day down. Next day gapped higher where I did take a partial profit and I got to trailing stop mode. I got to the orange line threshold, trailing stop mode threshold. The next day, remember, I'm in trailing stop mode now. The next day, we have our first close below a previous bar's low. What do? I sold half of the remaining shares that I had for a gain of 2.75%, but I kept the other half. Next day, we gap down, but reverse back up. Next day, profit target. Next day, profit target. Next day, no profit target. Next day, profit target into that strength. Next day, profit target into the strength. I'm always trying to take a little off when I have strength. Today, no profit targets and was down a little bit, but the remaining shares that I have here on Microsoft on this particular trade up 5.27%. And again, this was a combination of a deep dip buy, multiple deep dip buy signals, and a rejection of the bottom of the order block. So it's worked out pretty well. Apple's been a monster trade, really has been a monster trade. So I did enter Apple here on the 29th of June at 281.61. So let's take a look at the signals. The signal, the first signal was a rejection of the top of the green box. Okay, we've talked about rejections at the bottom, that's fine, but a rejection of the top of the green box is fine as well. But really, what got me interested in this trade was this megaphone trend line. A megaphone trend line is simply when you have a swing low and then you have a lower swing low and you connect the first swing low to the second swing low, and then the slope of the trend line goes out into the future. If I get a rejection of that megaphone trend line, meaning it was below it but closed back above it, that's a good sign. It's rejecting a key level. So the confluence here was a rejection of the top of the order block and a rejection of the trend line. Now the only thing I have to figure out is, well, let's do this. So I position size correctly. I placed my emergency stop 2 ATRs below as always. But the subjective question here is, where is my stop? Now, there's no wrong answer. There's just pluses and minuses. I could pick a close below the low of the order block. I could pick a close below the red line, the 100-day moving average. But I picked this level here, this custom level 278.90, this green line. If I have a close below that green line, I'm going to get out. And you can see my entry point is very close to that green line, so it gives me a good risk to reward ratio. But the real question is, why did I make this custom level? And it has to do with the day before. You see this big up bar here the day before I entered the trade? Well, when you have a big up bar, there's a tendency from a Fibonacci standpoint to have support at halfway of between the low and the high of the bar, and that is it. And so I just know this from experience. When I have a big up bar, halfway of that big up bar, there's some inherent support. So I took the trade because it rejected the top of the order block, rejected the megaphone trend line. I entered at 281.61, emergency stop 2 ATRs below. My end of bar stop is simply a close below here, the green line, 278.90. I'm very close to it, so good risk to reward ratio. After that, I placed my 1.5 ATR trailing stop level above, and the next day took off like a rocket ship. Sold profit targets into that strength. Next day up again. Sold into that strength. Next day, huge monster day up where I hit multiple profit targets and I obviously got to trailing stop mode. Next day up again, profit target. Then we had a few days of sideways motion here. And then here on the 13th, we moved up really quite strong where I did hit a profit target. And then here on the 14th was our first close below a previous bar's low. After reaching trailing stop level, what do? I took off half of the position, and I took off half of the position there at looks like 10.54%. Was the first close below the previous bar's low. But I didn't sell all, I just sold half the remaining shares. The next day up again, massively strong. Sold partial profits into that strength. Next day up again, profit target into that strength. Today, no profit targets, but at this point, this trade becomes very easy. Look at this, we're at a 71.66 RSI. So whenever you get up into these elevated 70 levels, now in the future, if I have a close below the 70 RSI, I will again sell half of whatever I have remaining. And after that, if I have a close below a previous bar's low, I will exit the entire position. So, you know, I'm just kind of in the mindset here of this trade's probably done pretty quickly at this point. It was a massive trade. But if I have a close below the 70 RSI next week, I'll get out of half. If I then have a close below previous bar's low after the 70 RSI rejection, I will get out of all. Conversely, do you see the blue line that we have here? This is the 5 EMA. If next week, Monday, it closes below the 5 EMA, I'm simply out of the trade as well. Whenever I get to a 65 RSI level, then my full exit out of the trade is if I have a close below the 5 EMA. So I sold half on the 14th of July for a gain of 10.54%. And the remaining shares here that I have at the moment are up 15.60%. So really good trade. Again, using the combination of an order block and this time a rejection of a megaphone trend line. Qs. All right. Well, I have been short the Qs ever since 6/22, June 22nd. And I did short the Qs here at 737.77. So the question is why? Well, we've talked about bullish order blocks, the green boxes. Well, there is such thing as a bearish order block, which is the red boxes. So let me explain to you the rules for a bearish order block. It's just the opposite of a bullish order block. For a bearish order block, we need to start with the swing high first, then look for a swing low, then look for a higher swing high, and then you have to have a move down that takes out that swing low. As soon as that happens, which it did here, now the highest closing bar prior to market structure change to the downside is your bearish order block. And in the future, if you rally back up to that level, that is the shortable level. And so I entered here on the 22nd. I shorted at 737.77 for two reasons. We rejected the bottom of the bearish order block and we had a bearish V1. If you want to learn more about V1s, V2s, go to my YouTube channel. I have a video there. V1s, V2s are a huge part of my trading, and I just can't imagine how they wouldn't improve everybody's trading. But go watch the video and it will explain why. But a bearish V1 consists of two bars, bar 1 and bar 2. Bar 2 has to go above bar 1's high, which it did, and then close below bar 1's low, which it did. Now, on the V1 or a V2, my stop is halfway of the washout bar. The number 2 bar is the washout bar. And so this custom level I put here, 739.70, the red line, that is my stop. Of course, I have my emergency stop 2 ATRs above like I always do, but I want my end of bar stop to be pretty close to my entry so I have a good risk to reward ratio. Well, that's pretty dang close, okay? So I shorted here 737.77. Because I'm short, I placed my trailing stop level 1.5 ATRs below. Next day, after I took the trade, collapsed. Hit multiple profit targets into that strength and also got to trailing stop level in one day. The next day, it did go lower. I took another profit target. Next day, gapped up higher. Now remember, I'm in trailing stop modes. Bearish trailing stop mode. So if I have a close above a previous bar's high, I will get out of half. This certainly opened above the high, but closed below the high, so that kept me in the trade. The next day, We had another move down where I took more partial profits and covered more shorts into that weakness. Next day, we had our first close above the previous bar's high because we're short. And so I exited half of the position for a gain of 1.95%. But I still have half. The next day, huge move up. I thought, well, I'm going to get stopped out. It's going to close above that 739.70 level, but it did not. So I kept the other short half. Next day, we moved down, took profit targets into that. Next day, big down, took profit targets into that. Next day up, no profit targets. Next day down, profit targets. Next day, not a profit target. Then we rallied for a couple days. Here on the 13th, had a big move down. Or again, I took profit targets into the weakness. And then over the last 2 days from here to here, profit targets. And today, of course, was down big where I hit multiple profit targets into that weakness. So I'm not quite out of the trade yet, but the remaining shares that I have on this short are up 6.09%. NVDA. All right. I entered NVIDIA here on the 7th of July at 196.33. Why? Rejection of the bottom of the order block. This order block comes from the past. Previous day, we closed below it. On the day that I entered it, we opened below it, closed back above it. In addition to that, we had a V1, a bullish V1. So that is why I entered here, 196.93. I placed my emergency stop 2 ATRs below. My end of bar stop was simply a close below the order block. And look, I entered here, the bottom of the order block's here. So the next day, if it closed below here, I'm simply out. Always want to start with a good risk to reward ratio. Placed my trailing stop level 1.5 ATRs above. Next day, took off like a rocket ship. Very grateful for that. And hit multiple profit targets into that strength. Next day, no profit targets, was down a little. Next day, big day up again, where I again sold multiple profit targets into that strength. Also got to trailing stop mode. Next day down, next day up strong, multiple profit targets into that move. And then today was our first close below a previous bar's low after reaching trailing stop level. I took off half of the position for a gain of 2.89%, and the remaining half that I still have up 2.89%. And then Disney. I did take Disney here on the 15th of July at 97.15. Why? This is a little different strategy. This is called a higher low V2. So let me bring your attention to these two green lines, this bottom green line and this top green line. Anywhere below the top green line, anywhere above the bottom green line, anywhere in this channel is considered the value zone. And so one of my favorite setups is what's called a higher low V1, V2 in the value zone. And the first requirement is that you need to close below the bottom of the value zone, which we did here. The second requirement is you need to go back into the value zone, which we did. The third requirement is you have to have a pullback followed by a V1 or a V2 that closes in the value zone. Here's the V2, bar 1, bar 2, bar 3. 2 goes under bar 1's low, 3 closes above bar 1's close. Closed in the value zone. The reason it's called a higher low V1 or a higher low V2 is that this low here is higher than this low. And listen, when you're trying to get long, higher low anything is the way to go. It's better than a lower low. Look, here's a lower low. What did it do? It bounced and failed. Higher lows tend to have easier up moves. So I took the trade here. 97.15 with a higher low V2. I placed my emergency stop, of course, 2 ATRs below. Now, on a higher low V1 or V2, your end of bar stop, or my end of bar stop, is based upon halfway of the number 2 bar, or the washout bar on the V2. Bar 1, 2, 3, here is the Number 2 bar, we call it the washout bar because it washes out or goes below bar 1. I simply have the level of halfway of that bar. So I entered here 97.15. If it closes below 97.15, that's it. I'm done. That's my end of bar stop. I placed my trailing stop level 1.5 ATRs above, and the next day, man, it took off like crazy. I hit multiple profit targets into that strength. I remember thinking, oh, just give me a little bit more and I could get to trailing stop mode. But today, no, gave back a lot, almost all of that gain. So you can see, well, I hope you can see. Can you see why I'm glad I took the profits up here when I had them at least now, because it was reversed, right? But nonetheless, really glad I hit those profit targets into that strength. But the remaining shares that I have on the trade so far still up 0.54%. But going forward, again, if we close below halfway of the washout bar, 95.77, that's it. I'm done. If it continues to move up, I will continue to take partial profits if the market gives it to me. If I get to the orange line, if I get to trailing stop level, then I'm going to go into trailing stop mode. All right, so that's it on the open share. So, I mean, really a good week. I mean, Walmart remaining shares up 2.14%, CRM remaining shares up 11, or all the shares, 11.99%, Microsoft up 5.27%, Apple, big trade, remaining shares up 15.6%, the Q short up 6.09%, NVDA up 2.89%, and Disney, as I mentioned, up 0.54%. So lots of profits in the open positions that I still have. Now, I did exit 3 trades last week, not all profitable, but let me go through. So Netflix. I entered Netflix here on the 1st of July at 73.79. This was a combination of a close under, close over the 30 RSI, and a V2. So I entered here 73.79. I placed my emergency stop 2 ATRs below. My end of bar stops closed below the halfway of the V2, 72.40. I placed my trailing stop level 1.5 ATRs above. Next day after I took the trade, took off like a rocket ship. Perfect. Sold into the strength, got to trailing stop level. Next day was down, next day up, sold a profit target in that. The next day here was our first close below a previous bar's low after reaching trailing stop level. I took off half the position for a gain of 2.47%. The next day was down slightly. The next day down, but it did not close below my stop. The next day we had a rally before it reversed where I hit a profit target. Next day down, next day profit target during the high of the day. And then I exited the remainers of the shares here on the 16th for a gain of the remaining up 0.81%. But I got out. Why did I get out? Well, obviously you can see that I'm glad that I got out, but I got out because there was earnings. I don't hold through earnings, everybody. It's a great way to make a lot of money fast. It's a great way to lose a lot of money fast, and I just don't like the risk of holding through earnings. And had I held through earnings, look what would have happened. Now, could have done the opposite too. Happens to me for sure. But just in general, you know, as a trader, your real responsibility is holding on to the money that you have. Placing yourself in front of a earnings train is a really good way to lose a lot of money quickly, and I just don't want to put myself in that position. So that's why I did exit. Obviously, I'm glad I did. So the remaining shares exited for a gain of 0.81%. BIIB, man, this one was a bummer. Really a bummer. So I took BIIB here on the 10th of July at 199.12. Why? Simple rejection of the gray line, which is the 50-day moving average, simple rejection of the 50-day moving average inside a bullish order block, key level within a key level, and a V1. I entered here 159.12. I placed my emergency stop 2 ATRs below. My end bar stop is simply a close below the 50-day moving average, which I entered close to anyway. I put my trailing stop level 1.5 ATRs above. I entered the trade. Next day, took off like a rocket ship. And thank goodness I hit multiple profit targets into that strength, because the next day, kaboom. Big down bar, obviously closed below the 50-day moving average. I had to exit the trade for the remaining shares for a loss of 3.45%. But this is a very good example of everybody. See how important it was that I hit multiple profit targets to reduce my position size before that happened. Had I not done that, I would have had a straight 3.45% loss, but I didn't have that much loss because I hit partial profit targets in the strength. And then I got out, and then it went right back up. Happens, right? That's just part of trading. But I did have to get out of that for a loss, the remaining shares of 3.45%. And CCJ is the last one. CCJ, I entered here on the 8th of July at 94.81, rejection of the 300-day moving average inside the order block. I got in 94.81, placed my emergency stop 2 ATRs below. My end of bar stop was simply closed below the 300-day moving average. I placed my 1.5 ATR trailing stop level. This trade never really quite got going. It did go up the next day, hit a profit target, but that was about it. And then here on the 13th, it clearly closed below the 300-day moving average. I exited the trade, which, no fun, loss of 5.16%, but in hindsight, am I glad I exited the trade? Yeah, you bet, right? You don't win them all, but taking a loss is tough. But when you take a loss and 3 or 4, 5 days later, it's way below, you're like, oh yeah, good boy. Glad I did that. But I did take a loss here for a total of 5.16%. So on the closed trades, Netflix remaining shares up 0.81%, BIIB loss of 3.45, and CCJ a loss of 5.10. So, just kind of as an aside, you know, everybody's going to have winning trades and losing trades. It's okay. But the key is, for me at least, is when you have winning trades like these guys over here, the open positions, I stay in them. As long as they're winning, as long as I'm on the right side of them and I'm profitable, I'm bullish. I'm going to stay long with them. However, you can see the 3 that I got out pretty quick because they didn't work. So that's the key. Being patient with your winning trades and being very impatient with your losing trades. I have lots of losing trades, but what you'll see on my trades is I'm usually in, out after day 2, 3, 4 days. I'm out if they don't work. Other positions I can be in for weeks or months if they're going in my direction. So just remember what I'm saying. Be patient with your winning trades, be impatient with your losing trades, and get yourself a process that shows you how to be patient with your winning trades and how to be impatient with your losing trades. So those are the positions, open, closed, how I manage them. Hope that was helpful for you. And now let's talk a little bit about trader psychology, okay? All right, so this trading psychology tweet is from Scott Trades. You can follow Scott Trades at Scott Trades over on X. But I was looking through the different posts that I wanted to talk about, and this one really good. So just wanted to highlight this. Scott says, the more I surround myself with and get to know professional traders, the more I realize they don't make calls. They manage risk and use levels. They fight for price. Anytime that they are right on a trade, they fully know that it could have gone the other way. And the reason I picked this trade is I speak with a lot of traders each week, and the common denominator is that the successful traders that I know do not say, oh, yeah, this is going up, or yeah, this is going down. The traders that struggle the most that I know are the ones that are like, oh, yeah, it's Tuesday, it has to do this, or uh, for whatever reason, it's going up. For sure, it's going up. For sure, it's going down. And whenever I hear that, it's like nails on a chalkboard to me because no one knows. I mean, if there is no such thing as a sure trade, and if they say that and it's right, they're like, "See, I told you." And I'm like, "Yeah," but when it goes the other way, you don't hear from them about it. So my advice is be very open and fluid to the idea that you do not know where your trade is going. And if you think the trade is going up and then it doesn't, you're kind of more likely to stay in the trade because you thought it was going up for sure. So maybe it will tomorrow. Maybe it will. It's just a rocky road, everybody. Like Scott says, the more he gets to know professional traders, the more he realizes that they don't make calls. Everything is about managing risk and using levels. For me, it's the same. Above this level, I'm bullish. Below this level, I'm out, right? And I do know that it could go any way. And when you do know that it could have gone against you, when you're open to the idea it can go against you, you're more likely to get out of the trade. So again, my friendly advice is stay very open-minded to the fact that yes, this could go up or yes, it could go down, and try not to be definitive about your market calls. So thanks a lot, Scott. Appreciate that. Hope you're doing well. And you can follow Scott over at Scott Trades over on X. All right. Well, let's get to the potential trades for next week. So I have 7 of them. Now, again, these are not where they need to be yet, but they're getting kind of close, potentially getting there. And so I'm just going to, I looked at them last night. I've marked them up. I will follow them next week. And if they get to those levels or reject those levels, I will consider taking the trade. Now, I have 7 of them. Is it possible, for example, Monday, that all 7 of these could trigger? And the answer is yes. Of course, it is possible they could all trigger. Does that mean I would take all 7 trades? And the answer is absolutely not. I have a rule. I only take 1 trade per day. Doesn't matter if I have 20 that look perfect. I have to narrow the 20 down to 1. And so how do I do that? I give every setup a quality score. Just to make it simple, if it has 1 signal, okay, I give it a score of 1. If it has 2 signals, okay, I give it a score of 2, and so forth. But you may have something that has 5 signals but has a horrible risk to reward ratio. If that happens, I have to deduct points, right? So I always have to be aware of the risk to reward ratio. A lot of times you can see something with 10 signals, but the risk to reward so horrible you wouldn't be able to take it. So I also look at the higher time frames to see if I can get some clues from there. So example, if I'm trading the daily charts, I could look to the weekly charts, see if the weekly charts give me any clues. Maybe there's some rejections of some key levels on the weekly charts. I also look at relative strength. If the market's down, but one particular market was up, I probably get that an extra bonus point or two because it was a lot stronger than the rest of the market. And so I kind of put them all together, give it a quality score, and that's how I trade. And that is what I do. And that is what I teach my students. And if I could just take a couple minutes to put in quick plug for myself and what I do teach people, students all over the world. I have done it for almost 10 years now. I love to teach, and I teach my students all the different trading strategies that I use in a 20-hour one-on-one course. It's just me and the student, 2 hours a week for 10 weeks. So we're together for 2.5 months on a weekly basis. And I teach students all the rules, all the strategies. It's great to have it over 10 weeks because we're constantly looking at the market evolving and so forth and so on. But I'd love to have you as a student. I will teach you everything I know. The course does cost $2,000, so I know it's a lot of money, but it's an investment in learning a skill that you can use the rest of your life. And so if you are interested in studying with me, if you're interested in becoming my student, um, just send me an email. The email is in the link of this YouTube video, and we can start, discussing the format of the course and so forth. But again, love to have you as a student. Just send me an email. As an alternative to the 20-hour one-on-one course, I do have a really good video course available at udemy.com where I teach you step-by-step the deep dip buy stock trading strategy. Now, this is just one strategy, but the video is 9.5 hours long. I teach you all the rules for the deep dip buy. And deep dip buy is great. And a lot of the trades I showed you today involve the deep dip buy. So 2 options, the one-on-one course with me, 2 hours a week for 10 weeks, or the Udemy online video course for the deep dip buy. And my email and the link to the Udemy course is in my description in this YouTube channel. So anyway, thank you for putting in my plug, letting me put in my plug, and let's talk about the potential trades for next week. So the first on deck is AMD. So AMD has this nice order block down here. Now, are we close to it? Not really. Could we get there next week? Yeah, 100%, absolutely we could. And let's talk about why this is an order block. Well, look, here's a swing low, here's the swing high, here's the lower swing low, here's the market structure change. By taking out the swing high, this becomes the order block. Then it moved up really strongly. Again, when you were up here, was this smart money? Yeah, for sure it was. In hindsight, well, we're kind of on our way back down to the smart money area. Doesn't mean it'll be smart money again, but the chances are fairly good. And so what I am looking for is not really a rejection of the high of the order block. I'm looking for a rejection of 409. This is the custom level that I put in here, the green bar. Why this 409? Here we have a V2, bar 1, 2, and 3, halfway of the V2 inherent Fibonacci support. That's the level that I would key off of, the 409 level. So next week, if we reject the 409 level, I would potentially take the trade. And my end of bar stop would simply be a close back below the 409 in the future. Okay. The other possibility is if we have an under 30 over 30 RSI signal in this order block. That's the deep dip buy, right? So and it's kind of hard to predict RSIs and when it would happen because it depends how long it takes to come down and so forth. But this level here, this order block level, is the key level. So 2 things. I'm looking for a potential rejection of 409 and or a rejection of the 30 RSI on AMD. Intel. Well, Intel has just come straight down. Boy, it's nasty, huh? I think that's 33% this month. So there is an order block. You can see this green box from the past. Here's an order block. Look at the bottom of the order block. What do we have? We have the 200-day moving average. I love major moving averages that coincide or live inside a bullish order block. Now, we're quite a long ways away from there. Are we going to get there? I don't know. But look, we have earnings on the 23rd. Now, Intel could just go way up on earnings. Who knows? But it could come way down on earnings. Generally, I wouldn't show you this so far away from the entry. But because of earnings, there's the distinct possibility that we could come down and reject the bottom of that order block. I would even consider taking the trade if we rejected the high of the order block, which looks like it's 69.33. So rejection of 69.33, I would consider taking it. My close, my end of bar stop would be a close below the 200-day moving average. Or if it rejects the bottom of the order block, it's going to reject the 200-day as well, and then I would use the 200-day moving average as my end of bar stop. So it quite a long ways away. I don't know, but with earnings, there certainly is a possibility you could have a big move down, and if it does, I want to be ready and have those levels marked out. The Russell 2000, I have been talking about this for several weeks. It's the same trade. We have this order block here, and I have this key level in the order block of 284.30. That is just the halfway of this V1, so that's my custom level. So it has come down. It has not come back into the order block, but if it does, my first level that I would consider, rejection of 284.30, and then my stop would then be a close below 284.30. McDonald's. All right, this is kind of a tricky one. So McDonald's has not had a good time lately. It's moved down very, very strongly. You can see here's this order block, the top and the bottom of the order block. On Thursday, I theoretically could have taken the trade. Why? Because the day before we closed under and then we closed above. I didn't really like the risk to reward ratio, so I didn't take it. And had I taken it, I would have had to have gotten out today because it closed back below the order block. But these three bars here is a V2. Bar 1, bar 2, 3. 2 goes under bar 1's low, 3 closes above bar 1's close. Where is the support level on a V2? Halfway the washout bar. You can see today we got within a few pennies of that level. Now we still close below the order block, but it held the halfway of the V2. So what I'm getting to is next week, if we do close back in the order block, not way up here, because it's not a good risk to reward ratio, but if we were to have a gentle close back in above the bottom of the order back and close back in the green, I would consider taking that, and then my stop again would be a close back below the low of the order block. But yeah, big reversal today, but it kind of held the key level the halfway the V2. So I could see it closing back in the order block. And if it does, I consider it and then getting out with the close below the order block. And it looks like the below the order block is 268.49. So that's what I'm looking for on McDonald's. Silver, man, silver has just had a tough time. I mean, I took a trade on silver and got stopped out, hit my emergency stop, as a matter of fact, because this has been a big, long slog down here. But there's a key level coming up on silver. It's an order block down here at about 45.92. Right now we're at 50.78. So next week, if we continue down and we reject the high of this order block at 45.92, I would consider taking it. My stop would be a close back below the low of the order block at about 44.28. And so I don't know if it's going to get there. If it does, I'll consider taking trade. But what's interesting about this setup is that we have a really nice double bottom bullish MACD divergence going on. If you look here at this low here, do you see the deep red bars? These are negative MACD bars. These are red MACD bars. So we had this huge move down here and the bars got pretty deep, indicating a lot of selling momentum. Then we rallied into green. Well, look at this. We are lower here than we are over here, yet we don't even have any red bars. If you've heard about a double bottom bullish MACD divergence, you know that that indicates that you are running out of selling momentum. And if you run out of selling momentum, the implication is you're running out of sellers, and therefore the implication is that you're going to go up. But in this case, we don't even have any red bars. Big picture, this is quite bullish. Quite bullish to have a double bottom bullish MACD divergence with a missing right shoulder. But I still need an entry signal to get into it. Now, an under 30, over 30 before we get to the bullish order block? Yeah, possible. We're at 34.72. So if we go under 30, over 30, I would consider getting in that trade even if we don't get to the order block. My stop would be then a close back under 30. So it would have to go under 30, over 30. My stop would be closed back under 30. If it just heads down and slices through the 30, again, this order block here, 45.83, rejection of that high of the order block or the rejection of the low of the order block, 44.38. Certainly I would consider taking that trade, and then my stop would be a close back below the order block. But I really like the fact that we have this double bottom bullish MACD divergence with bonus points on top, missing right shoulder. We have an RSI divergence, we have ATR divergences, we have all sorts of divergences that kind of scream that we're running out of sellers and that a potential rally could be near. Potential. I don't know for sure, right? But an under 30, over 30, I'd probably try that, get in with that. My stop will be closed back under 30 or a rejection of this bottom order block. Just basically rough numbers, just call it 46 to 44. So, kind of mid 40s in there would be the interesting spot. TLT, which are bonds. So bonds have had a tough time of it for sure. There's two key levels that I'm looking for on TLT. And I'd mentioned to you before when I use abandoned babies, instead of going into trailing stop mode, taking partial profits, I usually just set a two ATR two ATR stop and a four ATR profit target. There's two potential levels that I'm going to be potentially doing this with on TLT. You can see today, well, not today, but I mean today made it, but we have a bullish abandoned baby. You can say Wednesday we gapped down. Today we gapped up, bearish, bullish. The high of this abandoned baby, which was Thursday, if we reject 84.21, I would definitely consider taking the trade. 2 ATR stop, 4 ATR profit target. Conversely, we have another abandoned baby down here. And again, the top of the abandoned baby is the key level. That is 83.25. So just to make it simple, if I get a rejection of 84.21, meaning we get to it and bounce, or we go underneath it and then close back above it, there's two levels that I'm considering getting long here. If we get a rejection of 84.21, which is the higher top of the abandoned baby, or a rejection of 83.25, which is the high of the lower abandoned baby. And so if either of those trigger and I take the trade, 2 ATR stop, 4 ATR profit target. And by the way, these bullish babies, the higher one and the lower one, are inside this bullish order block from the past. And then last but not least is UAL. So, with oil prices going back up dramatically this week, of course, that is, having an effect on airlines with the cost of their jet fuel. But we have a nice potential easy trade here. Not easy like it's easy to make money, but it's quite obvious. We have a bullish order block, swing low, swing high, lower swing low, market structure change, coming back to the order block or coming back to the previous smart money. Inside the smart money, we have a couple key moving averages, key levels that savvy institutions, large financial institutions, savvy traders key off of these levels. And we have the 200-day moving average here at 104.43. We have the 250-day moving average here at 103.32. Just a rejection of either the 200 or the 250 would be a legitimate entry signal, but of course I like to look for confluences, and the confluences, these major moving averages, the 200 and the 250, are inside this previous smart money area or this order block. So if UAL, United Airlines, does come down and reject the 200 or reject the 250, I would consider taking the trade. My end of bar stop would be a close back under whichever moving average that it rejected. So those are the 7 that I have for next week. I'll be watching those carefully. I hope you found today's podcast helpful. Again, if you did, if you could take just a quick second, hit the thumbs up button, I would really appreciate that. I hope you have a really good rest of your weekend. Have a baseball game tomorrow. Pumped for that, excited for that. Hope that I get a hit. If you have any questions about anything I mentioned in the podcast today, please put them in the comment section. I'll do my best to get back with you with an answer. I always like to leave off with, I have this little podcast, I have this little platform, but I always try to use it for a little something good. And I always like to leave off with, listen, if you have the opportunity on any particular day to do something nice for another person, even a small little thing, do it. It's a win-win. They will appreciate it. It'll make them feel good. It'll make you feel good. And I think we could use a lot more of that in this world. If we all just did one nice thing for another human being each day, man, I just think the world would be a better place. Also, I'm a big animal lover, and same thing goes for that. If you have the opportunity to potentially, do an act of kindness for an animal, if you have the opportunity, do it. They appreciate acts of kindness just like we do. So I always like to leave off with that. But I hope you enjoy your weekend, everybody. I really do. Get some rest, study up on your charts, get ready for Monday, and God willing, I will see you next week. All right. So be careful, follow your process, and if you do that over time, I think you'll do all right. Thanks again, everybody, for watching. Appreciate you. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.